Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, member LevFin alum gives us a 10-minute primer on mezzanine financing and shares his career path. Learn about why he got into investment banking in the first place, what's the hardest part about running his own shop, as well as his one piece of advice to his younger self. Enjoy. LevFin alum, thanks so much for joining the Wall Street Oasis podcast.
No, happy to do it, and look forward to seeing how I can help.
So it'd be great if you could give everyone just a short bio.
Yeah, so over my career now has spanned, almost 25, 26 years. Started off generically out of undergrad in investment banking in New York. Did that through the 2-year analyst program into, an associate. Left that firm to continue to still in the leveraged finance business on the buy side. With a mezzanine / equity fund, also based in New York. Did that for another few years, deciding, I was living in New York, and reached the point where I thought, I can continue down this path and probably have a pretty good life, but decided at some point I needed to grow up. So I thought grad school was a great way to do that, and decided to move back towards where I grew up, closer to Texas. And so ended up at grad school in Dallas and have continued a career at post MBA in the deal finance world. First in project finance, funding and investing in power projects. Then back into leverage finance in some capacity as an advisor, then as a lender directly. Finally, at a boutique operational turnaround specialist. I was based mostly in Dallas. The firm itself was based elsewhere, but after building a network here, decided that I would want to continue to do what I did, but started my own firm 3 years ago, and have been doing similar, although maybe down market in terms of size, call it $2 to $7 million of EBITDA for companies based here in Texas and in the surrounding states. So career has tracked somewhat in the deal business, although a few stops along the way. Yeah,
for sure. Thanks for that summary there. So let's just start.
Boring summary.
No, it's great. Let's start all the way back at undergrad. So you went to what I would call almost like a semi-targeted grade school, graduating in the mid '90s. And tell me what it was like. Was there, you ended up getting into a LevFin group at what would you call that? A boutique, middle market firm back then?
It was a large bank.
Large bank. Okay.
Can
you tell me about like how you got? I assume you had some internships. Maybe you didn't. I don't know what it was like back then. But what was the recruiting like?
Yes. So my only internship throughout college was I worked for two brokers who your traditional brokers, wealth managers, I guess they're called now. And doing whatever it is that interns do. And back in undergrad, I really had some idea of what the differences were among commercial banks and investment banks, and certainly on the investor side, what private equity and other alternative asset managers were. Didn't really understand the nuances, certainly, that do exist. All I knew was my undergrad degree was in finance. Enjoyed the deal business at some level, and how I got into the business really was obviously they're the big firms, the bulge brackets, came onto campus to recruit. I dropped my resume, had a good interview with a firm, and 4 weeks later, had an offer, and that's what started the whole journey.
Yeah, I know it was a while ago, but did you prep a certain way? Anything surprising? Any funny interview stories from back then? Did you flame out on anything, or did you just crush every interview that came your way? Do you actually remember anything about like the number of resume drops you put in and your like how many you actually converted to interviews? Do you remember anything?
I don't remember the exact number of drops, but
Yeah.
I will say that let's say I dropped 10, the conversion rate to interviews was like 9. So
really
it
good.
was high, and I guess it's higher. I don't know if that's high, but and I think the reason is that because of the school I attended and because of the nature of the firms that were recruiting at our school, there was a lot of alums.
Yep.
And I think that a lot of decision makers were alums, and as a result, I think all things being equal, alums like to be surrounded by other alums, or at least the senior alums, the senior guys who are alums like to have their ego stroked by the junior guys who are alums, and so I think that's perhaps one of the accidental benefits of being at the school I was and being recruited out of the by the groups that we were. And so
you make it
lucky or good.
Yeah, so you make it up to New York. You're in this LevFin group. You're doing a lot of good transactions. You are there for a good 4+ years. Getting promoted analyst to associate with no MBA. Was that standard back then, or what was the thought process? Hey, I'm going to be a banker for life here, or what was the thought process around that?
I would like to say that there was a big plan in place, and that was my goal. It was really not really having a lot of people in my network or friends going through. We were all going through it at the same time, so none of us really had any visibility into what the life was going to be like, or the path. I think that's not entirely true. I think certain of my peers had a very good idea, had it all mapped out to some degree, and had a plan to how to get there. I think mine was sort of a less proactive than it probably could have been, but more reactive to different opportunities that I had. And
do you think that was maybe because you were working long hours, or were the hours long? And is it something where you just kind of had your head down?
Yes, I think as far as work hours per week, I think even today, you don't know what it's like, but it's probably pretty similar. Crushing 80 to 90 to 100-hour weeks. Who no one really knew what time off meant, and vacations were actually. One thing I do remember is that when you are when you're able to schedule, say, a week off, people pretty much left you alone, and so I think that people valued the work time certainly, but people also recognize that, gosh, if we crush them too hard for too long without break, the usefulness or how much contribution these guys can make is just diminishing. So
yeah, and
I think that there was definitely an effort to make sure we had some time away completely.
Yeah, and I think we're seeing a lot more of that nowadays with the competition from tech. You see all the bulge brackets making a push towards improving the lifestyle for the analysts and the junior bankers, with time off and all that stuff from pencils down Friday night to Saturday morning, or I think it's Saturday or something like that, and then other banks do at least 1 weekend off per month type of thing. Right. So that's interesting. So that even back then, at least at this bank, it was a little bit more. As a first year analyst, you were actually able to take a vacation, a 1 week vacation or 2 weeks, or not?
I think it was after.
Your first year.
Let me get this. Yeah, I think it was after. I think what I learned quickly is that the work calendar doesn't track any traditional calendar at all. Mm-hmm. So even though it's, for example, the holidays, doesn't mean that people stop.
right.
or that I should stop, or we should stop working. It tracks a deal calendar, which is whatever stage your transaction or pitch or whatever is in. That's what you should be doing, no matter if it's a holiday or it's somebody's wedding or it's somebody's birthday. It doesn't matter.
Sure.
I think that you're getting it done because that's the culture. It's a culture of somewhat FaceTime, of course.
Yep.
Bad or good, but also the teams. I'm sure this is true today. Are staffed so leanly, or you're spread so thin across so many interesting and maybe less interesting transactions that you're pretty leveraged. You're pretty maxed out at all times. If you had any capacity, that's almost viewed negatively versus keeping yourself fully engaged.
Yeah, the staffer would always try to make sure you were at full capacity, right?
Exactly.
So question. So for the people who are a little bit less familiar with mezzanine, can you explain to them like what mezzanine capital markets is, or what are mezzanine investments, and how, like, the type of work you were doing? Just because I think people have heard the term, but not everyone knows what it is.
So, my mezzanine career tracked both the sell side and the buy side. So on the sell side, it's what you might imagine in terms of, I was in a capital markets group. What does that mean? Really, our role a little bit different from origination in that it was our responsibility to generate the relationships with the actual purchasers, the investors of the mezzanine debt and equity, on occasion, securities that were being originated by our coverage groups.
Right.
And so, not to get too basic, but the way that we thought about mezzanine, especially private, were the gap financing in lower middle market deals, such that a mezzanine financing could be anywhere from, in our group, from $5 to $7 million all the way up to $50 million. But basically filling a hole among private investors versus the bigger public institutional, or I should say, between the bigger institutional dollars that were buying leveraged loans and high yield bonds. So these were private, more privately negotiated, bespoke or one-off type financing opportunities for those type deals.
And back then, did most of them have like equity kickers and warrants attached to them? So if a certain valuation was hit, that they would convert to equity, or they could convert to equity, or a small percentage?
So the answer to your question is we structure them as their debt securities with equity kickers. So in other words, with equity warrants attached, such that because if you think about a capital structure, there was some contractual return, but a lot of times these lenders were taking a hybrid of debt and equity risk. So they would price in some of that equity risk by taking a certain percentage of the company's equity, oftentimes anywhere from a point to 5 to 10%. Rarely do we ever see it up at 10, but 5 is pretty average.
Yeah, 1 to 5 is what I had seen, at least back in the day when I was interviewing for a mezz fund way back in the day.
Yeah.
But so
exactly.
I'm curious, the way I should think about this. So when people were structuring these debt securities with equity or warrants attached, those equity or warrants, was it typically something where it would convert no matter what, or only would convert at a specific valuation, like on a financing event? Or just it converted after a certain amount of time? Like how are they typically structured? Because I think myself and the listeners might actually learn something from understanding how those are structured. And if you know how they're structured today, have things changed on that at all? Do you know?
So I think that it's been fairly consistent with a warrant. So warrants are detachable. In other words, they can be detached from your bonds and traded independently. And really, what is a warrant for equity? It's really a long-term call option on the equity of the company.
Okay.
And it's your right, not your obligation, to convert, to buy equity and have that. If it goes public, obviously there's a market for your securities.
Right.
And you can structure warrants however you want, and the way that ours typically were, one, they were detachable. Two, that they were cashless exercise. In other words, you didn't have to pay to exercise your warrant. They were pennies.
Almost like more like restricted stock or something like that.
Almost.
Yeah.
Almost. They were unregistered.
Yep.
But on a change of, let's say there's a change of control. It's the easiest example. Company gets sold or acquired. Your warrants immediately vest or convert, or you can redeem them into the amount of the equity that's stated on the warrant. And so
that makes sense. And what about the underlying debt portion? Did the interest rate, was it typically higher than a subordinated note, like a unsecured bond, or was it because it had the equity upside? Was it priced typically under that? Do you remember around? Was it like 8 to 15%?
So these things were fairly typical. Structure would be an 11 to 13% cash coupon on the underlying debt, maybe 1 to 4% PIK. PIK, payment in kind.
Yep.
In other words, you just get paid in more bonds. At the time, say there was a 1 year non-call period, then some sort of call schedule after a year or after however much time. Typically, on the buy side, we structured at least 2 year non-call. With some sort of make-whole provision in the meantime. If you really had to redeem these ahead of the call schedule, there was a mechanism for that. But we as investors, you want to know your money is tied up for at least a minimum amount of time before it gets called back or redeemed or repaid. Because if you're going through the effort to make the investment, you want it working for you
at least a couple of years or something. Yeah, that makes sense.
Otherwise, the reinvestment risk of having to redeploy that capital if it comes back too soon or it comes back quickly, to find another
opportunity.
18 to 21% return is
very hard.
Difficult.
Yeah. So you're saying that a mezz lender could potentially get 11 to 13% cash coupon plus 1 to 3% PIK, payment in kind, meaning it's getting rolled back into the balance of the thing. So it's really almost like 15 to 16%. Plus they could actually have some warrants detachable warrants on that piece of paper. So it's a pretty expensive.
Yes, exactly.
It's pretty expensive financing for a company, correct? And it should be what kind of companies would do this? Like, why wouldn't they just go get a secured bank loan? Maybe they don't have enough assets, but is it typically because a bank won't give them a loan, or what's the situation here? Distressed?
Yes, it's an expensive, quote unquote, relative piece of paper compared to debt. It's always going to be cheaper than equity. Is what the way to think about it is that if you're raising $20 million in financing, and the dilution from having to give up, say, a 5% warrant versus a $20 million equity direct investment is significantly different.
Right.
But why are companies raising mezzanine capital? A few reasons. One is that there's an active market of investors purchasing these kinds of or investing in these kinds of securities, so that there's going to be some liquidity for that hole in the capital structure.
Yep.
Oftentimes, banks. So the way that we thought about the capital structure is you get a certain amount of leverage through the traditional bank market, and there's going to be, if it's a buyout, there's going to be an equity component in that. But to fill out the capital structure, in other words, to get all the cash needed for an acquisition, you might need to fill it with what's now or what can be is mezzanine debt. And
do you feel like that's becoming more common
are,
because leverage is so high on these buyouts right now that where people are trying to write, people are buying companies at 12 to 15 times EBITDA, and it's, they're getting 8 turns
yes.
of like senior debt? Or is this something where it's becoming more common, do you think?
Well, I think that where it has become more common,
lower middle market,
is that the middle market for sure. But how has the mezzanine market evolved? Rather than it being strictly basically a private high yield debt security, now what you're seeing are more creative senior financing, second lien, last out. Senior financing to help fill that financing potential financing gap, but with more senior paper, because a lot of CLOs, a lot of investors have or credit funds have the dedicated dollars or have an entire strategy built around senior financing with a little bit of yield. And how do you get that? It's in these other creative securities or creative financings that fill the same role as mezzanine, but maybe from a pricing standpoint are a little more competitive. In other words, LIBOR plus 10, LIBOR plus 9 versus a straight 11 to 13% cash plus PIK plus equity. You can still get your $20 million whole filled, but at a more cost competitive potentially.
Okay.
It doesn't always, it's still leverage. It's still debt. So you're still maxing out the cap structure to some extent.
Okay, so that's fair. Sorry to take you on that little tangent. I'll get back to your career now.
Yeah.
I think it's just
great question.
It's just interesting because there aren't a lot of, there's not a lot of information out there on like the mezz capital market. It's a very kind of niche space, and I thought it would be interesting to just hear about it.
It's a very subterranean world.
Yeah, sure. Exactly. So okay, so back to your background. So you kind of get promoted analyst to associate. Was there at any point before then were you thinking MBA? Were you thinking why kind of jump firms? And did the MBA ever kind of cross your mind before you jumped firms? What was the thought process around that?
Yeah, so getting promoted within the company was certainly the carrot that they offer internally as, hey, here's an opportunity. You work for an analyst for 3 years. If you do well, people want you to stick around. You can get promoted. Without your MBA, but separate from how it might work internally at firms, did the MBA ever come up? Oh, absolutely, it comes up. It's part of the analyst subculture dialogue of, gosh, do I go back to get my MBA? When do I do it? Where do I go? It's probably on your mind from the very day you start, which is because these programs are 2 and 3 years. Let's say there's no option for promotion. What do you do after 2 or 3 years? The natural migration, if you want to stay in the industry or an adjacent industry, is the MBA. Right. So it's and all your senior colleagues, the associates and on up to the MDs, 90%, at least the ones that I worked with, all had their MBAs from top schools. And so as far as it being part of the discussion or thought process, absolutely, because you're surrounded by. I was surrounded by some of the smartest people I think I've ever worked with or been around, and all went to great schools, and thought, wow, I think that that's probably my path too, and for not knowing anything else.
So why did you go to another firm and just take a promote? You ended up not going to the MBA right away. You ended up becoming a VP at another mezz firm, doing mezz type lending, right?
Yes. So I went from associate to whatever the equivalent. I can't even remember the title.
Assistant vice president.
AVP, which is probably the senior associate equivalent.
Okay.
why did I choose to do that? One, in 2000, whenever it was, right before my firm got acquired by another firm, there was a lot of turnover in the firm, which is, as I learned early in my career, turnover and jumping around from different firms is it happens every day. It's not something isolated. It's part of the culture of investment banking. Certainly at the time was taking your either your group or yourself and doing it at another firm for maybe a lot more compensation, especially around guarantees. But why I did, there was an opportunity to join a client of ours who I really respected and thought that what a great way to learn a different side of the business as an investor versus on the sell side. So it was I don't want to say it was a natural extension of what I was doing, but it certainly made sense at the time.
Well, it was basically going to the buy side, basically, right? So you went from sell side to buy side.
Basically going to the buy side, exactly.
Yeah, which is what a lot of people do nowadays. So it makes perfect sense. And you were there for a good number of years. You were there for 3 years before kind of deciding.
Yes.
The MBA was your thing. It does look like you had a little bit of an entrepreneurial stint there before the MBA. You kind of co-found a startup. We don't have to say what it is because then it'll probably be obvious who you are. But the point is like
what it taught me was while I thought that I had a pretty good background in finance and in the deal world, what I didn't have a great background in at all was, how do you operate a business? How do you come up with a growth strategy, marketing, all those things that you kind of hear about and learn about that other companies do. But when you're a practitioner, an operator, and certainly I had no background in anything other than an Excel spreadsheet. I thought, well, maybe grad school is the way to learn these things and also enhance what I already know. And so it was, I would say at the time, granted, I was perhaps a standard deviation or two older than the average age of going back to grad school, but it made all the sense in the world to me if I wanted to continue to stay in the world in finance or in any role. Because of the things you learn or the networks you build, all those things.
So going into your MBA, you kind of knew you wanted to stay in finance, and you basically were going in there. Was there a thought of, hey, I'm going to go investment banking, I'm going to go back to sell side, or was it, hey, I definitely want to stay buy side? What was the thought process kind of going into your MBA? Like, did you know what you were going to recruit for right when you started? I know you were trying to get, it sounds like closer to home, closer to family. So you went to school down south, but if you could just tell me a little bit about like the thought process of kind of going into that program.
Sure. Well, my stated thesis at the time was, as an entrepreneur, as I mentioned, I had no background really as a manager. And I thought that I had, decent enough overall business judgment. As I quickly learned, I had zero skills. And anything other than if you needed someone to build an Excel spreadsheet with sources and uses and a debt cap table, I was probably pretty good at that, but that's about it. And so really the idea was to go into grad school and really get a background, a better one, in those skills where I had no background, marketing, strategy, management, and see if being an entrepreneur or business owner or was going to make sense in the middle of my.
It sounds like
in the middle.
Yeah, I was just gonna say it sounds like you kind of had your eye towards your own thing for a while, but then coming out of your MBA, you really kind of stayed in finance for a little longer. Is that accurate?
Yes, I
did another let me see, 1, 2, 3, 4. Almost like 5, 6 years, 8 years almost before you kind of jump back to the startup scene?
The classic, what do what do startups today do when they find out that their initial strategy might not be working? They pivot.
Right.
So what did I do in grad school? I pivoted.
Yeah.
I pivoted, but it wasn't a pivot away from being an entrepreneur or business owner or senior manager at a more corporate firm. It was a pivot back towards a world I was already somewhat familiar with. In the world of finance. And so, but the difference might be that instead of migrating myself back to the Northeast, back to New York, I would do it in the
near family,
in the Southwest,
near family,
where I was back in grad school. So I think that certainly came true as I finished out the program. But I got some great advice from an undergrad professor talking about an MBA who said, "Gosh, if you really want to get the most out of your MBA program, you could go back to the same school you did your undergrad and probably pretty do well, or go to similar schools that everybody else does who come out of finance or investment banking in New York. But why not try to maximize your MBA experience by going someplace completely different, a different geography, a different network, your classmates who come from different industries. And that way you can take what you've already learned sort of on the job or pre-MBA career and not only learn new skills, but also at the same time get more familiar with less familiar industries and less familiar geographies."
Did you feel like
that's what brought me back to where I went to school?
And do you think that was good advice long term now looking back?
Absolutely.
Yeah.
I think that there is, for me, that was a right decision. Only because I think that living the New York City private equity investment banking lifestyle, it's a great one and one that persists for many people for many years. And people do very well, obviously. But I think, but for me, I thought that I think I miss working in New York sometimes, but I don't know if I miss living there all the time. And so, for me, the lifestyle choice of being in a different environment, doing the same thing, doing Wall Street on Main Street, if that's the most abused cliche in the world, was an opportunity to do that, and certainly the trade-offs are many. Certainly lifestyle, certainly upside potentially, and all the trappings of what makes New York such a wonderful city to live and work in. It remains that way, and I can visit, but still get to come back to something of a lifestyle choice, or way, or at least a completely different geography to come back to live in, to grow a family in, for example.
Yeah.
And I think that's sort of how the career and choices have panned out to
for sure
to do what I enjoy, but to do it in an environment that's more supportive of planting roots for long term.
For sure. So you're coming out of your MBA. You kind of, you're at these kind of well-known firms for a year, anywhere from a year and a half to a year to 2.5 years, doing everything from. You did even another stint in an independent strategic advisory firm, but some as an investment associate at another firm. Sourcing, evaluating, monitoring private placed debt. So kind of similar to what you were doing pre-MBA. Is that fair?
Yes, that's fair.
And then you kind of you moved out west. So tell me about that. Why? Did you have family in Dallas? And then what was the decision to move out west?
So the decision to move out to California really was an opportunity to pursue and grow an underwriting group that a large international bank was growing in the Western U.S. So in other words, they had an Eastern U.S. presence.
But personally,
with
like what was
and underwriting?
Were you married?
So
were you married at the time?
So
like personally,
this is the thing. This is sort of the funny part of it.
Yeah.
Which is got married in the early part of November, the year I started at the bank. 10 days later, we were driving a U-Haul from 3 days after our honeymoon ended. We were driving as a newly married couple from familiar to less familiar, but more interesting geography and weather in Southern California.
Yeah.
So I think that was we thought the thesis, to use that word again, starting off as a young couple. Why not do it in a completely different environment? That way, we are relying on each other for.
Was her family back in this
for the stability?
Was her family as well back in the South, away from California?
There was family, so all our networks and family and support was here in Texas.
Yeah, so
it's tough. we were relocating to a place where certainly we didn't have. I had my sister at the time. She's obviously still my sister, but my sister at the time was living in LA. So we had a family member who was going to be out there. But interestingly enough, my sister has relocated back to where we are now, and so we are all back together again.
Good. That's good to hear. It's tough. It's tough moving away from family, especially once you start a family and everything. And I know my parents are out east, and Terry, my wife's family's kind of Southern California. We're Northern California. It's tough. It's tough sometimes, especially with a lot of young kids. But anyway, so you're taking this opportunity. It's a career opportunity. You move out west, away from family. And tell me kind of let's get to the entrepreneurial stuff. So you ended up jumping to another firm in an MD capacity, doing kind of, it sounds like more going back to sell side. Is that accurate?
Yes. So, but what's unique about that firm was that it was very operational focused. In other words, yes, we did the more traditional things that advisors do, M&A, sell and buy side, but we also did a heavy amount of restructuring work, and an even probably heavier amount of distressed sale or creditor advisory related to debt restructuring. So I think that was interesting in all kinds of ways.
Yeah.
One, it was an entrepreneurial firm started by a career entrepreneur who happened to just be very successful in turning around businesses as a board member, and thought, gosh, I wonder if there's a way to grow what I'm doing as a board member, but to build a business around it. And today, it's a premier. That business is a leader in boutique sort of advisory around certainly restructurings, but more generally in M&A. In the 4 or 5 verticals that they're in, I think they are
they do really well.
A leading firm in the lower middle market, and so it was really that model and my experience there and my relationships with those principals there that gave me any confidence at all and inspiration to go out on my own.
So tell me about that. You're starting your own boutique advisory firm for the lower middle market. Is that correct? But you're also, it's almost like a merchant bank model, right? Where you're also providing potentially direct investments as well, or helping source that?
Yes, exactly.
So is it from your own capital, or is it from you have the connections to the investors and you provide that service for fee and stuff like that? Or are you actually taking ownership? Is your firm taking ownership in some of these firms?
We are, what we say we do 2 things. One, we're an advisor, and specifically in exit sort of financing, not exit, but exits of founders of businesses. And so, a lot of times, our typical client is someone reaching retirement, where a business is in a family or been in a family for a generation or two.
And they don't want to pass it on to their kids. They're worried about passing it on to their kids, so they want to liquidate. No, I'm just kidding.
There's no interest.
Yeah.
There's no
fair.
Either there's no confidence or there's no interest.
Fair.
Among the next generation, and I think that they are asking themselves, especially in the lower middle market, gosh, what are my options? What are my strategic alternatives?
Right.
What does that even mean?
Right.
And so I think that by and large, we spend a lot of our time just in helping people, helping illustrate anywhere from what the math looks like to what a process looks like, and helping them to prepare. If it's not imminent, a lot of questions we address are, what can we be doing in the business today if in 2 to 3 years or longer, I want to, sell my business, sell our business. And that's what we do. And, I think that, where we are geographically, a lot of businesses of that size in a number of different kinds of industries. And so I think that it's a longer lead cycle, because if you are obviously helping someone address some questions 2 years out from any sort of process, then it's a little bit longer than what your typical life cycle might look like. But
right.
But if you think about it, the way that we think about it, or I do, is if you're trying to be someone's trusted advisor, you don't parachute in overnight and become someone's trusted advisor. You have to earn it. And you earn it by one is referrals. That counts a lot. But two is by showing and demonstrating and answering questions and being transparent, open, and honest about what it is that they can expect in terms of anywhere from how long does it usually take, what does the process look like, what's the difference between this type of private equity firm versus a family office. So it's a lot of just, yes, somewhat educating the market, but also by being someone's resource for answering questions that this is probably the first time they've ever faced them.
So it sounds like you have,
but sometimes it is.
You have a pretty solid network. It sounds like, in the South or in your area. So you've been able to kind of source those, the referrals. So you're getting business that way. What's been the hardest part about going out on your own? Has it been just the volatility? And I'm sure, some months it's, you have a big fee and then the next month you have zero. And is it the volatility in earnings? Is it the recruiting talent? Is it what's been the hardest thing about what you've done kind of starting out on your own?
The hardest is the volatility. It's the feast, famine, downside protection of trade-off. So what I mean by that is, yes, certainly when you're working for yourself, the upside can be pretty uncapped, depending on just many things. But the downside is also uncapped because if you're running a business as a business, you're incurring whatever costs you are, and you may not make anything for that month, the next month,
right,
third month, or the fourth month. And there has to be some comfort, or not comfort, but you have to get comfortable with being uncomfortable, believing that you are doing it right, or as I do, at the end of every year, at the beginning of the new year, which is to say, okay, do I still enjoy what I'm doing? Is it still generating enough positive net income to support the family? And do I still get the quality time in and around family, such that that's why I'm doing it in the first place?
Right.
So I think that those are questions that I think I should ask. Everyone should ask themselves, no matter what their career, but it's certainly as a having my own business is something that I'm more keenly aware of, which
That's
is
fair.
all the ups and downs, all the costs of managing an advisory / investment type firm, and to answer one of your other questions, it's our capital that we invest, or that if it's the size or interesting enough, we will certainly bring in friends of the firm to help fill out financing. But these are the difference is that the advisory business focuses on middle market companies. The investment business is early stage businesses, early stage companies.
Fair.
And so somewhat complementary of the advisory business, somewhat not.
Mm-hmm.
I would say it's complementary in that we continue to we just have are always in some sort of deal flow conversation, either as investors or as advisors.
For sure.
And so it keeps the networks fresh and new and growing.
That's great. Listen, before we wrap up, anything else you would kind of share with your younger self or the young listeners? A piece of any wise words of wisdom before we call it?
I think that if I could advise my younger self or at least provide an overview for anyone considering the early stages of this career, which is, don't let money be the guiding factor among the choices that you make early.
Mm-hmm.
I think that what perhaps might be a better guide for earlier in your career is asking the question less, where can I make the most money versus where can I learn the most?
Right.
Where can I have the most responsibility at an early stage in my life or early stage in my career life, such that I will be learning by fire versus settling or not settling, depending how you look at it, for the most compensation. Because when you're in your early 20s, mid 20s, everybody's sort of roughly around the same. It's when you get later on where the differentiators happen in your earning capacity, but those are all determined by how much you've learned and how much experience you've been able to accumulate across different roles, different industries.
Yeah, when people ask me, I would add to that advice and say, don't chase the extra $10,000 if it's not as good a learning experience, but also don't chase the name. Oftentimes people will be willing to take a middle office or back office position at a bulge bracket investment bank and turn down a solid middle market investment banking front office position, which blows my mind because you're going to be doing completely opposite work and it pigeonholes you, or not opposite work, but completely irrelevant work at the middle office or back office, making it almost impossible for you to get to the front office, where if you start in the front office or get there quickly, it's much easier to lateral firms within a year or two. So
it is. You're absolutely right.
So it's really important that you don't chase the prestige or the money early in your career. The leverage is later. Because
you're right. And when you are switching firms, the first things they're going to ask, especially front office, is what have you worked on, and what deals have you worked on? Did you work? Everybody knows what deals all the other firms are doing, and they'll ask you, well, I really wasn't on the front office part of bulge bracket firm, and then they'll quickly find out, well, you're probably not the greatest fit. Even though you're coming from a even bulgier bracket firm, but if you're coming from a just hyperactive deal environment at a lesser known firm, people are going to find out that, oh wow, you worked on that deal, that buyout, that IPO, that M&A, and you'll be able to speak to things you actually did, as opposed to yes, my firm was involved in all
as
these
opposed to leaning on the name
deals, but I was messengering bank documents back and forth from the 7th floor to the 11th floor. That's a different experience, and people are smart enough to ask the right questions to figure out what you actually did.
For sure. Well, listen, LevFin alum, thank you so much for taking the time out of your busy schedule, your entrepreneurial schedule, to educate us.
My pleasure. I look forward to figuring out how else I can answer other questions, but looking forward to the Wall Street Oasis. Thank you.
Awesome. Thank you. And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. And until next time.